Gold sits at the crossroads of macro risk and central bank behavior, and today that crossroads feels sharper than it has in years. Amid rising geopolitical frictions, weakening real yields, and demand from emerging market buyers, prices react to every headline. Investors bet on a store of value when confidence wobbles and currencies slip. At the same time, rapid monetary shifts and energy scares remind traders that nothing is truly risk-free. If the goal is preservation of purchasing power, gold often becomes the loudest bell ringer in a complex economic orchestra. Market participants watch central bank minutes for clues about a possible rate path. Gold is a monetary asset with no counterparty risk. Valued in US dollars, yet priced by demand across wallets and funds. When real yields fall or negative rates linger, the opportunity cost of holding shiny metal declines, nudging prices higher. When stocks wobble or currencies falter, buyers flock to bullion as diversification insurance. Markets measure liquidity by futures volumes, ETF inflows, and jewelry demand in key economies. Today, the metal trades around the mid-2000s per ounce as inflation expectations wobble and central banks hint at gradual easing. The process blends sentiment, supply constraints, and long-run changes in demand. Gold has served as a trusted store of value for millennia, from ancient civilizations to modern central banks. Its appeal blends scarcity, durability, and fungibility, creating a universal unit of account when trust in paper money falters. In the 20th century, nations embraced gold reserves as anchors to monetary policy, culminating in the Bretton Woods era when currencies were linked to gold at fixed rates. After the system unraveled in the 1970s, markets learned to price gold as a hedge against inflation, geopolitics, and risk. Since then, central banks have quietly accumulated bullion, signaling long-term demand beyond jewelry and industry. Across markets, bullion is trading with renewed volatility as traders digest data surprises and policy comments. Spot gold hovered near 2100 to 2300 range depending on dollar strength and risk appetite, while futures curves show a modest backwardation in some contracts. ETFs have swung between inflows and outflows as risk sentiment shifts, with gold positions swelling during periods of geopolitical headlines and retreating when liquidity returns to equities. Jewelry demand in Asia and China both influence weekly flows. In short, gold prices mirror a balancing act between macro tension and the pace of dollar normalization. Volatility remains a feature, not a flaw. Miners benefit from rising bullion prices even when equities struggle, but the impact depends on margins and costs. Major producers such as Newmont and Barrick operate across hedged and unhedged portfolios, so price spikes can lift earnings, yet pressure project returns when cash costs climb. Banks and wealth managers adapt their client exposure through bullion products, streaming agreements, and structured notes. Central banks holding gold reserves influence longer-term demand, while exchange-traded products channel demand from retail buyers seeking liquidity and a tangible hedge. Mining companies adjust capital priorities to reflect higher price expectations, while refiners secure supply through long-term contracts. In sum, the money flow signals a cautiously constructive posture toward gold amid uncertain skies. Supply discipline at mines and recycling dynamics also shape availability. Geopolitics and macro policy remain the engines behind gold flows. A stronger dollar or rising real yields tend to dampen enthusiasm for non-yielding assets, while a softer currency can lift bids. After a string of sanctions episodes and geopolitical flashpoints, investors price risk by layering gold into diversified portfolios. Central bank gold purchases add a floor to prices even when other assets wobble, signaling a longer horizon of demand. Global growth concerns and risk-off periods push allocators toward bullion as a liquidity backstop. Energy prices, inflation expectations, and political calendars all interact to set the daily pulse of the metal. Smart money reveals itself in timing and positioning. Large asset managers have nudged allocations toward bullion as a hedge against policy surprises, with some funds elevating weightings in multi-asset portfolios. Hedge funds have explored momentum plays on gold futures, while adding options to capture rising volatility. Central banks continue to diversify reserves, and exchange-traded products channel demand from retail buyers seeking liquidity and a tangible hedge. Mining companies adjust capital priorities to reflect higher price expectations, while refiners secure supply through long-term contracts. In sum, the money flow signals a cautiously constructive posture toward gold amid uncertain skies. Even with momentum, gold faces meaningful risks that could derail the rally. A decisive dollar breakout or a sustained rise in real yields often squeezes bullion, as investors reprice the opportunity cost. If global growth accelerates and risk appetite returns, capital may flow back into equities, draining safe haven demand. Central banks could revise reserves away from gold if alternatives prevail, while improvements in energy markets weaken inflation fears and reduce hedging needs. Physical supply disruptions can reverse, but recycling margins and mining costs keep price floors uncertain. Given these variables, the upside may hinge on policy surprises rather than pure momentum. For retail investors, the path is careful and informed. First, consider gold as a small percentage of a diversified portfolio rather than a single bet. Dollar-cost averaging helps smooth entry amid volatile moves and reduces timing risk. Exchange-traded products and streaming notes offer liquid exposure, while antiques and jewelry remain non-investable assets. Monitor real yields and dollar trends rather than chasing every headline. If you choose miners, favor lower-cost producers with transparent hedges and strong balance sheets. Always set stop losses and define a clear exit plan before allocating capital to bullion or related instruments. Patience and discipline beat impulse in volatile markets. Looking ahead, gold still faces a tug-of-war between policy caution and inflation resilience. If banks maintain tilts and the dollar stabilizes, bullion could drift to new highs or consolidate in a wide range for months. Conversely, surprise rate cuts or a normalization of risk assets could cap gains and push investors towards cyclicals. The most robust path combines disciplined risk management with selective exposure, leveraging both bullion and miners to capture different drivers of value. For now, maintain a plan, monitor inflation data, and stay prepared for shifts in sentiment. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.